$45,000. That number sits in a strange place for most people. It's large enough that spending it feels serious, but not large enough to feel life-changing when it comes to investing. It's the kind of amount that creates hesitation. If you spend it, you wonder whether it was the smartest move. If you invest it, you wonder whether it's big enough to really matter. And that's exactly where John finds himself. He has $45,000 sitting in his account. No debt tied to it, no loans, no obligations, just money that he worked hard to save. And he has his eye on something very specific, a Tesla Model Tri. It's not an outrageous purchase. It's not a luxury supercar. It's simply a modern, efficient car that happens to cost almost exactly the same as the amount in his account, which means the decision seems simple. John could walk into a dealership today, sign the paperwork, and drive home with the car he wants. The transaction would be clean and immediate. But the moment he does that, something else happens. His bank account drops to almost zero. That's the part people rarely stop to think about. They focus on the purchase itself, the excitement of owning the car, the satisfaction of finally getting something they've been working toward. But they rarely think about what life feels like after the money leaves the account. Because having $45,000 in your account gives you something beyond purchasing power. It gives you options. Unexpected expenses don't feel urgent. Decisions don't feel rushed. There's breathing room between you and the next financial surprise. But when that same account balance suddenly drops close to zero, everything feels different. Small problems feel larger. Unexpected bills feel stressful. Every decision suddenly carries more pressure because there's no cushion left underneath it. The money didn't just disappear. The flexibility that came with it disappeared too. And that realization is what causes John to pause. He isn't struggling to afford the Tesla. That's not the problem. The real question is what happens after the purchase is finished. Once the money leaves the account, it stops working for him entirely. So instead of asking the usual question most people ask, can I afford this? John asks a much better one. Is there a way to get the car without destroying everything I've already built? That question changes everything because most people follow the same financial order without even realizing it. They save money first, then they spend it, and whatever happens afterward is treated as an afterthought. But wealth usually works in the reverse order. You protect the core first, and then you let growth pay for the things you want. So John makes one simple rule before doing anything else. The $45,000 stays untouched. No dipping into it. No slowly shaving off pieces of it. That money becomes the engine instead of the fuel. The Tesla doesn't get paid for by sacrifice. It gets paid for by returns. And once that rule is set, the problem becomes a lot more interesting. Because now the question isn't whether John can buy the Tesla. The question becomes how quickly his investments can buy it for him. And that's where the story starts to change. Once John decides the $45,000 itself stays untouched, the next question becomes obvious. Where does the growth come from? Because if the goal is buying the Tesla without spending the original money, then the investment gains have to generate another $45,000 on their own. For most people, the first instinct is a savings account. And on the surface, that sounds responsible. Savings accounts feel safe. The balance slowly moves upward. There's no volatility, no surprises, no uncomfortable swings in value. But safety always has a cost. Right now, even a strong high-yield savings account pays somewhere around 4% to 5% per year. Let's translate that into John's situation. On $45,000, a 4% return produces about $1,800 per year. At 5%, that rises to roughly $2,250 per year. Now compare that to the goal. John needs another $45,000 in gains to pay for the Tesla while leaving the original balance intact. At those savings account returns, that process would take roughly 20 to 25 years. 2 full decades of waiting. And during those 2 decades, inflation continues moving forward. the price of cars rises, the cost of living increases, and the purchasing power of that money slowly erodes. The account balance technically grows, but the progress toward the goal barely moves. That's the hidden limitation of savings accounts. They are excellent tools for protecting money, but they were never designed to multiply it quickly. And when the goal is turning $45,000 into another $45,000 within a reasonable timeline, slow growth becomes the bottleneck. So John crosses savings accounts off the list. The next option most people consider is individual stocks. But that creates another problem. Picking individual stocks requires constant research, constant monitoring, and a willingness to accept that a single bad decision can erase years of progress. Most people don't want to spend their time tracking dozens of companies or trying to predict which single business will dominate the AI industry. And with a technology wave as large as artificial intelligence, guessing wrong about the biggest winners becomes even easier. This is where ETFs enter the picture. An ETF, an exchange-traded fund, allows an investor to buy a basket of companies instead of betting on just one. Instead of choosing a single AI company, John can own dozens or even hundreds of businesses involved in artificial intelligence. Some companies build the chips. Some build the software. Others provide the cloud infrastructure, the data centers, or the automation systems that make AI possible. If one company struggles, others continue moving forward. That diversification matters because the AI industry is still evolving. No one knows exactly where the biggest long-term winners will come from. Will it be software platforms, semiconductor manufacturers, robotics companies, cloud infrastructure providers? The truth is, it will likely be all of them together. And ETFs allow investors to capture that broader trend without needing to guess every detail perfectly. For John, this simplifies the entire challenge. The starting point remains the same, $45,000 in cash. The goal also stays the same, a 50-10 niche Tesla Model Tri. The only thing that changes is the path between those 2 points. Different AI ETFs grow at different speeds. Some move slowly and steadily. Others move aggressively, producing faster gains but with more volatility along the way. And the difference between those speeds isn't small. It can mean waiting nearly a decade or reaching the same goal in just a few years. So instead of choosing randomly, John decides to rank the options based on a single question. How quickly can each AI ETF realistically generate $45,000 in gains without touching the original investment? And starting at the bottom of the list is the most conservative option. At number 5 on John's list is the Global Robotics and Automation Index ETF, ticker symbol ROBO. This is the slowest option on the list, but it's also the most conservative. ROBO focuses on robotics and automation technologies that are already deeply embedded in the global economy. Instead of chasing speculative breakthroughs, this ETF invests in companies building the machines and systems businesses are already relying on every day. Think about factory robots assembling products on manufacturing lines, warehouse automation systems moving packages across logistics networks, software platforms coordinating machines that allow companies to produce more with fewer human hours. None of this is science fiction. Automation has been expanding across industries for decades because it reduces costs, increases efficiency, and minimizes human error. Robo captures that steady industrial side of artificial intelligence. Inside the fund are companies that design robotic systems, supply critical components, and develop automation software that helps businesses run more efficiently. What makes Robo particularly interesting is its long track record. Unlike many newer AI-focused funds, Robo has existed long enough to move through multiple market cycles. It has experienced strong bull markets, economic slowdowns, and periods of heavy volatility. And through all of that, automation has continued expanding across global supply chains. That steady adoption shows up clearly in the numbers. Over the last year, Robo returned approximately 21.8%.
Compared to some of the more aggressive AI investments we'll look at later, that may not seem explosive, but it represents consistent growth driven by real demand for automation technology.
The more important story appears when we zoom out further. Over the last decade, Robo has gained roughly 235%. That means the ETF didn't rely on one exceptional year or a single breakthrough technology. Instead, it benefited from the long-term expansion of automation across manufacturing, logistics, and industrial systems worldwide. When that long-term performance is smoothed into a yearly growth rate, Robo's compound annual growth rate comes out to around 13.1%. This number matters because it removes the noise of individual years. Markets rarely move in straight lines. Some years are strong, others are weaker. But the compound annual growth rate gives us a clearer picture of how an investment has realistically grown over time. Now let's bring that back to John's goal. At a 13.1% average annual return, John's $45,000 investment generates roughly $5,900 per year in gains. At that pace, reaching the additional $45,000 required to buy the Tesla would take approximately 7 years and 6 months. That's a dramatic improvement compared to the savings account timeline of more than 2 decades. But it's still not the fastest option available. Robo shows us something important, though. Even the most conservative AI ETF on the list already cuts the waiting time by more than half. And as John moves further up the list, the timelines begin shrinking even faster because the next ETF doesn't just focus on automation. It expands into the entire artificial intelligence ecosystem. At number 4 on John's list is a broader and faster moving option, the Global X Artificial Intelligence and Technology ETF, ticker symbol AIQ. While Robo focuses primarily on automation and robotics, AIQ widens the lens significantly. Instead of concentrating on machines and factory systems, this ETF spreads across the entire artificial intelligence ecosystem. That means AIQ invests in companies that are building AI technology, as well as companies that are using AI to accelerate their businesses. Inside the fund, you'll find cloud computing platforms, data analytics companies, software developers, and technology providers integrating artificial intelligence directly into their products. Some of these businesses are designing the tools that power AI. Others are deploying those tools across industries like finance, healthcare, logistics, and digital services. This broader approach means AIQ benefits whenever artificial intelligence spreads into new parts of the economy. As AI transitions from a specialized technology into something businesses use every day, funds like AIQ are positioned to capture that expansion. That wider exposure shows up clearly in the ETF's recent performance. Over the last year, AIQ delivered a return of roughly 28.7%. That's noticeably stronger than the more conservative automation-focused approach we saw earlier with Robo. But the more meaningful insight appears when we look beyond a single year. Since its launch in 2018, AIQ has risen by approximately 250%. What makes that number even more interesting is the time frame. It took AIQ roughly 7 years to reach that level of growth. Compare that to Robo, which produced a similar overall return of about 235%, but required closer to 10 years to get there. In other words, the total return was similar, but the timeline was shorter. When we translate that performance into a yearly pace, AIQ's compound annual growth rate comes out to around 20.4%. And that difference changes the math significantly. At a 20.4% average annual return, John's $45,000 investment produces roughly $9,100 per year in gains. At that speed, the timeline to generate another $45,000 drops to approximately 4 years and 11 months. In other words, by expanding beyond automation and into the entire AI ecosystem, the waiting time shrinks by nearly 3 years. That acceleration highlights an important point. Artificial intelligence isn't just a single technology. It's an entire network of industries evolving together. Software companies, data infrastructure providers, chip manufacturers, and cloud platforms are all participating in the same growth wave. And ETFs like AIQ capture that broader expansion. But even with this wider exposure, there's still a faster path. Because underneath the AI software and platforms sits something even more fundamental: the hardware powering everything. Without it, artificial intelligence simply doesn't function. And that's where the next ETF in John's ranking takes us. At number 3 on John's list is the VanEck Semiconductor ETF, ticker symbol SMH. This ETF shifts the focus one level deeper into the artificial intelligence ecosystem. Instead of investing in companies that build AI software or deploy AI tools, SMH focuses on the companies that make the entire system possible in the first place. Semiconductors. Every AI model, every data center, every machine learning algorithm depends on enormous amounts of computing power. And that computing power comes from advanced chips. Without semiconductors, artificial intelligence simply doesn't scale. SMH invests in the companies designing and manufacturing those chips, businesses responsible for producing the processors that power data centers, train AI models, and run the complex calculations required by modern technology. As AI adoption spreads across industries, the demand for computing power rises alongside it. Every company building AI infrastructure needs more processing capacity, more specialized chips, and more advanced manufacturing technology. That growing demand is exactly why the semiconductor industry has become one of the fastest moving segments of the entire AI economy. And that momentum shows up clearly in the ETF's recent performance. Over the last year, SMH returned approximately 49.9%. That kind of growth reflects how aggressively companies are investing in AI infrastructure.
Businesses across the world are racing to expand data centers, upgrade computing systems, and secure the processing power needed to train and deploy AI models.
But just like with the other ETFs, the most important insight appears when we smooth out the long-term performance. When we convert SMH's growth into a compound annual rate, its CAGR comes out to roughly 28.5%. Now bring that back to John's goal. At a 28.5% average annual return, John's $45,000 investment generates roughly $12,800 per year in gains. At that pace, the additional $45,000 required to buy the Tesla would be generated in approximately 3 years and 6 months. The timeline that once looked like decades with a savings account has now collapsed to just a few years. But there are still faster paths, because some ETFs go beyond infrastructure and focus on technologies that directly reshape how industries operate. At number 2 on John's list sits the ARK Autonomous Technology and Robotics ETF, ticker symbol ARKQ. ARKQ takes a more aggressive approach. Instead of concentrating only on the infrastructure supporting AI, it invests in companies pushing AI directly into real-world applications. Autonomous vehicles, advanced robotics, energy storage systems, technologies designed to reduce the need for human input in everyday operations. These are the types of innovations capable of transforming entire industries. That aggressive positioning creates more volatility, but it also opens the door to faster growth when those technologies gain traction. Over the last year, ARKQ returned around 53%. Looking further back, over the last decade, the ETF has delivered a total return exceeding 700%. When we smooth that growth into a yearly pace, ARKQ's compound annual growth rate lands around 32.9%. At that speed, John's $45,000 produces roughly $14,800 per year in gains. That brings the timeline for generating another $45,000 down to approximately 3 years. But even that isn't the fastest path, because the final ETF on John's list focuses on something even more immediate: generative AI. The Roundhill Generative AI and Technology ETF, ticker symbol CHAT, is designed specifically around companies building and deploying the newest wave of AI technologies. These are the tools already transforming industries today. Systems that generate written content, AI models that write code, design platforms powered by machine learning, customer service automation, data analysis engines, and productivity tools used by millions of businesses. Unlike some of the other ETFs in this ranking, CHAT is actively managed. Instead of passively following an index, a management team constantly adjusts the holdings as the generative AI landscape evolves. When new leaders emerge in the field, the fund can adapt. When technologies shift, the portfolio can change alongside them. That flexibility matters in an industry moving this quickly. Over the last year, CHAT returned roughly 39.4%. And since launching in 2023, the ETF has already delivered total gains approaching 139%. When those numbers are translated into an annual pace, the compound growth rate comes out to roughly 36.8%. At that rate, John's $45,000 investment generates approximately $16,500 per year in gains. That means that Tesla could be paid for in about 2 years and 8 months. The difference between these strategies tells a powerful story. The savings account path takes 20 years. Robo cuts it to 7.5 years. AIQ drops it under 5 years. SMH brings it down to 3.5 years. ARKQ reaches the goal in about 3 years. And CHAT shortens the timeline to less than 3. Same starting money, same $45,000 goal. The only thing that changed was the strategy. And the difference between those strategies isn't just measured in percentages. It's measured in years of your life.